At a time where, of course, everyone's worried about exactly what's happening in the Middle East and the knock-on implications in terms of growth, in terms of inflation and the like, this week wraps up with the latest US jobs report. Notably, it is for the month of March, so it does at least tell us exactly how businesses are reacting to the ongoing developments in the Middle East and, of course, the potential rise in terms of inflation and the uncertainty that comes with it. So let's take a little look at the jobs report and see exactly how it could impact the likes of the US dollar, gold, and US stock market with the S&P 500. In terms of the report itself, you can see the breakdown here. According to Trading Economics, markets expecting a rebound after last month's 92K decline in terms of job creation. So will we see a welcome rise this time around? Now, bear in mind, when we're looking at previous revisions, generally they have been downward revisions. So that 92K decline might become even worse, quite frankly. So keep an eye out for the previous figures and previous and potential revisions. The unemployment rate expected to worsen with a rise up to 4.5%. Average hourly earnings down to 0.3 for the month, taking the year-on-year figure down to 3.6 from 3.8. So that would be welcome, certainly at a time of concern around inflation. Although some positive news on that front in terms of the participation rate expected to rise. 0.3 rise is actually quite significant in itself. In terms of the breakdown from last time around, you can see much of the job losses had come in the sort of private sector, minus 86K. And yeah, let's just look into some of these figures. And you can see in terms of last time around for the payrolls figure, the minus 92,000 reading was accompanied by a decline 2 months earlier as well. So a downward revision to previous figures as well. Much of the US economy seeing contraction in terms of job creation. Very few sectors really creating jobs. And by and large, the job creation has been driven by one area, and that is education and health services. And even on the occasion for February, we actually saw a decline for that as well. This week, we have seen the JOLTS numbers, but that was for February. The ADP payrolls figure came in largely flat from last time around. It's higher than markets had been anticipated. But you can see here, by and large, we have seen some areas of weakness, but relatively steady at the moment. Here's the breakdown in terms of that ADP payrolls release. So 62,000 jobs. In terms of the industry breakdown, it's really split between the two. Manufacturing, notably, alongside trade and transportation, the areas of weakness. Really, that's significant because those are the areas that, of course, Donald Trump would have you believe that he's bringing jobs back into the country to boost the manufacturing sector, to benefit from trade. Well, in actual fact, we're seeing quite the opposite at the moment. But by and large, a relatively fair spread that we're seeing across some of these different sectors. But what we can see once again in the service area is education and health really dominating, as you see many of these other areas like financial activity, 4,000, pretty minimal. But you can see in terms of certainly that education and health services continuing to be the area of strength. Now, in terms of how we might see markets reacting to the data, this is a relationship that sometimes is on, sometimes is off, but certainly the relationship between, say, payrolls and the dollar in the past has been viewed through the prism of a strong payrolls release should make us think that the economy is doing relatively well. They don't necessarily need to see as much of a hawkish outlook from the Federal Reserve. Whereas if you see weak data coming out, of course, it puts pressure on the Fed to start to act. And that's when you see weakness in terms of the US dollar. Now, what's the relationship right now where you would say that if we saw a strong figure, then that would point towards the Federal Reserve with their dual mandate of looking after the employment picture and the inflation picture? If we see elevated payrolls, then they're likely to focus more on the inflation side of things. And inflation is problematic. That means the possibility of a strong US dollar. So again, that positive relationship expected, much like we have on this chart, where a strong payrolls release would likely boost the dollar. And a similar kind of relationship you've got here in terms of bond yields and therefore market expectations for easing from the Fed. You can see in terms of the 2-year, the relationship is very close with the dollar index. And that signals the idea that if we have a perceived hawkish outlook from the Federal Reserve, then that, of course, provides a basis, for strength for the US dollar. Now, in terms of the US dollar, it has been very much driven by what's happening from the sort of geopolitical perspective, really. Everyone's trying to ascertain exactly when the end is for the war in Iran. We can see here in terms of euro dollar, we've got the possibility that we're sort of topping out here. So for, say, the dollar index or the US dollar as a whole, we can see that that would mean a basing, whereas on this occasion, we're seeing for euro dollar the potential for a top. Now, from a wider perspective, this monthly time frame actually really lines up with the long-term trend on the idea that we're potentially going to create a lower high. Now, bear in mind, we're getting very close to that prior swing high that we have on the monthlies, which is the peak that we had here in sort of beginning of 2021, 1.237. But we haven't broken it. And notably, we're coming back down towards this key area of support. So you can see 1145 has been taken out and then the low 114. So certainly looking like a potential bearish reversal, but more recently what we're seeing here is this sort of chop. So a lot of indecision on whether this is all just going to be blown over or whether we're due a massive crisis. And certainly this is the same kind of thing that we're seeing for many of these other charts, the likes of gold and the likes of oil, this rotation between the two. So through the context of the Federal Reserve and the jobs report, you would say, if we see a strong payrolls release, for example, you'd be expecting the possibility of a stronger US dollar that would drive this market lower. And so really, this is about inflation expectations and about the strength of the jobs market and the impact on the Federal Reserve. So, like I said, a strong report should drive us back down towards trendline support. A weaker one could potentially push us back towards the upside, towards that descending trend line. Of course, then if we broke through the 11625 level, then it starts looking like we're potentially pushing up from here. But certainly as things stand, there's a possibility we start to roll over from here, particularly if this crisis in the Middle East continues for longer. And certainly everything that we heard from Donald Trump in terms of his speech last night would indicate the idea that this is going to go on for, in his words, 2 to 3 weeks. But he can say that all he wants. He doesn't have a way to get out at the moment without just giving the Straits of Hormuz to Iran. So the idea that he's weakening them and then giving them the Straits of Hormuz to charge everyone money, it seems a little bit counterintuitive. So don't take the nuclear material, you don't get rid of the regime, and you give them the basis to be able to charge every tanker that passes through the Straits 2 million per tanker, or depending on the size. Not ideal. So he talks about getting out in a few weeks, but at the moment there's a lot of threatening, and it seems like the Iranians are happy to be patient. And the longer that runs on, the higher inflation looks like it's going to go, and in which case that would be bullish for the likes of the US dollar and therefore bearish for euro dollar and point towards the potential for a top here. In terms of gold, I mean, if we're looking at, say, the 4-hour chart, what we can see is this rally coming in as, of course, people start listening to Donald Trump and think, this is just about to end. It sounds like he wants to just get out. That's all well and good. But then his speech did quite the opposite. And so we're seeing it pulling back. Now, if we sort of tally up the relationship with many of these markets, really the idea is that rate expectations are impacted by the value of oil, for example, and inflation expectations. So we can see it here. If we invert the 2-year yield, you can see exactly how these markets are all just following the same pathway, but some of them are inverted. So what you're seeing in terms of the US dollar is related to the likes of gold, is related to the likes of stocks. So essentially, if we see data that comes out that makes us think that the Fed's going to be more hawkish and potentially hike, i.e. strong data, then that would be a negative for gold and point towards further downside to come and likely upside for the 2-year yield. And that's why we'd have it like this, right? So yeah, I mean, look, from the perspective of the charts, look, there's a lot of people calling this as the bottom, and certainly from a sort of candlestick perspective, it definitely looks very compelling. It's very difficult to know exactly how long this runs on for. It's the only thing. And certainly if we see things really start to escalate, of course, many of these countries have got ships still arriving in them across the world. But if all of a sudden you don't have any more ships, you see major shortages, you know, the sort of paper market versus the physical market in terms of oil, we have seen prices suppressed in the paper market. And so if we see a major surge in terms of oil prices because of an escalation in terms of boots on the ground, potentially, and something that signals this could actually last for another couple of months, or something akin to that. I mean, look, that could certainly lead us to a new high for oil, and a new high for oil means, in all likeliness, a new low for gold. The caveat here is that what we've seen in terms of this price action here points towards the likely move that we're going to see upon the completion of this war. And we don't know when it's going to happen, but we do know it will complete at some point. And so I guess the idea is we will see a rebound when this is all resolved. And so people are going to get back into gold. But the longer that this drags on for, the bigger the impact in terms of inflation. And therefore it enhances the downside and it limits the upside. Because if you're thinking about where gold was when we were, say, $60, $70 oil, and then you think about, well, oil might not go back to that anytime soon, so it might go back to 100, then maybe you come back up into the 5,000 mark. You don't come back up into the prior high for the time being. But I do think with the breakdown in terms of relations between many of the countries around the world, all thanks to the lovely Donald Trump, the geopolitics that are playing out at the moment, the rise in terms of debt, the narratives are still there for sure for gold. I wouldn't say that that's broken, but certainly right now, the shift in terms of the view from thinking the Fed are going to cut rates to potentially hike rates, that's what's really shifted the narrative for gold. And then finally, looking at the S&P 500, as we can see here, very clear trend in play here. Now, this is something that we put out on the Telegram earlier in the week, and I remember I posted it, I put it out there, and it was like around here. And I was saying, look, each time that we get stretched to the downside, as we can see here, the rebound is usually very deep and comes into the 76.4 fib and comes into trendline resistance. Well, it's actually worked out absolutely perfectly. Obviously, you always wonder whether this time is going to be different, but it's come right back down into trendline resistance, into the 76.4 absolutely perfectly, and now selling off heavily. So this really points towards a breakdown through the lows of 63.10 in my mind. Of course, we don't know that because we don't necessarily know what the headlines are going to come out with. Maybe they strike a deal and suddenly everything's going to be hunky-dory and we'll jump up, rally through 66.95 and push onwards and upwards from there. But of course, as things stand, it's not looking great. In terms of the relevance for the jobs report, look, like I said, all of these are inverted. Gold and the S&P 500 will be trading the same, of course, different magnitude in terms of the scale of the moves. But if we see gold selling off, then we're likely to see the S&P 500 and US stocks selling off, and that's at the same time as likely seeing upside in terms of oil and upside in terms of the US dollar. So if we see a stronger jobs report, then that could potentially drive this market lower. So I hope that's been useful. Make sure to like, subscribe, and follow for more. My name is Josh Mahoney, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.